Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Welcome, everybody. Thanks for joining us for our SCD Zoom call today. Today, we've got the CEO, Joseph Nakhla of Tribe Property Technologies. We've had Tribe here before. Tribe trades under the symbol TRBE on the Venture Exchange. We'll get into what Tribe does. I want to welcome Joseph back. I think we last spoke about a year ago. So happy to have you here, and certainly, looking forward to getting caught up. Joseph, welcome.
Thank you, Paul. It's great to be with you guys again.
As we go in, before we sort of get updated, why don't you remind us what Tribe's all about?
Yeah, absolutely. We are a property technology company, usually called prop tech company, really a company that's building a suite of products and services specific to the way people live in communities. Our company focuses on replacing traditional property management companies in residential living. So if you've ever lived in a condo or a rental building, you can go to a traditional property management company to take care of the community of the building and all its affairs, or you can come to Tribe, where we actually compete directly with property management companies, but except we deliver it on top of our digital products and services. So we digitize the building, and we actually are the property management company on record for both your condo communities or rental communities. And in a short period, we had practically nothing under management in terms of assets under management in January 2018, and as of today, we've got more than $22-23 billion worth of assets under management. So we're officially a national player and operating in all residential communities in the big markets in Canada.
Okay, that's great. Now, I took a look at sort of the news. What I usually do when I come up for an update, I check how busy you guys have been, and certainly there's a lot of news over the last year. Why don't we talk about some of the things that have happened? I mean, you've been active on the M&A side, you've been active with partnerships, you've been active in a whole bunch of different fronts. Why don't you sort of encapsulate what's happened over the last year for the company?
Yeah, for those that aren't as familiar with our growth strategy, when we went out to the market, we were questioning, will people purely take on a company like us that's digital first or technology backed? Will they allow us to manage a massive building of theirs, coming in with the technology, with the service layered on top? Fast forward now with more than 45,000, almost 48,000 homes under management, the quick answer has been yes. Then the other big component that we wanted to answer was, can we do it in different markets, different cities, different provinces? And again, we're operating in the 8 markets. So that answer has been yes. And then the other big component was, can we actually acquire traditional property management companies and actually put our technology and our back office into these current operating businesses and actually improve their gross margin, improve their revenue per door, and really deliver better service? And we started with our first acquisition in 2018, and since then we've done 12 acquisitions. So to answer your question specifically, we've been busy. COVID was an interesting time. We still made a couple of acquisitions through COVID, but obviously our inability to get on planes and meet people and build relationships was slightly hindered. But now that that's behind us, we've been able to get back on the horse of the M&A, and we've done a number of transactions in the last year, probably close to 4 transactions. Just announced one less than a month ago with our quarterly results, a sizable one in the GTA market.
Maybe before we get into some of the questions around the M&A side, give us a better sense of what you do. Like when you acquire one of these acquisitions, what do you change to make it better?
Yeah, we've got a full playbook for these acquisitions in terms of the way we integrate them. We start obviously by hardening their back office, their IT infrastructure. We take all of our applications that we've built, inclusive of portals for the homeowners or the tenants if it's a rental community. We have back office tools for accounting, back office tools for payments, and then on top of all that, we have a very strong engine that allows us to generate leads in that market. So when we make an acquisition, for the sake of a good example, would be the GTA announcement that we just made a few weeks ago, a company called Murtis Group out of the downtown core and the surrounding areas in the greater Toronto area. We were able to identify that company simply because we have a lot of leads in that market, and we needed to have the licensing and essentially the boots on the ground to be able to execute on the opportunities from a marketing point of view as well as service delivery point of view. So we have a full playbook, basically a 100-day strategy when we acquire these companies. And the big takeaway is most companies we purchase tend to have 10 to 15% annual churn on revenue. Although it doesn't look like it, they're usually flat line, meaning they lose 10% of the business, but they gain 10% from new business. It's a very high churn over industry due to most people not very happy with the service delivery. We as an organization nationally run less than 5% in our churn numbers. So that's one immediate difference, is we immediately buy these companies. We stop the bleeding from existing customers. We start generating more revenue per door. That's a function of more digital services available for us to generate more revenue from. And we immediately start improving the gross margin. Usually we buy them at 30% gross margin. And again, holistically as an organization, last quarter, we were running at about 41%. And that's with us making acquisitions, pulling our gross margin down. We think a fully baked national player like us will be hovering in the 50% plus in the near future.
Mm-hmm. And maybe a further step back, just in general, like when you take on a client, how do you get paid? Like, what's the business model for your entity, as opposed to maybe, is it different than sort of a standard property management firm?
Yeah, that's a great question. We have 3 revenue stream buckets, which is very different than most traditional property management companies. Our first bucket is a very sticky recurring business. We call that software and service licensing or fees. What that really, the way that works in the case of a condo, so think of a brand new condo or an existing condo. The condo corporation comes to us and maybe a couple of other property management companies. We all put RFPs, we win the business, then we actually control all the spend of that community, and a part of that we pay ourselves every month our maintenance fee. That's a very sticky business, and that line item is in the neighborhood of about $34 per month per door in the world of condo. That's our last quarter, and that tends to be about 15 to 20% higher than everybody else in the industry. And it's not a function of price elasticity here, because most people don't really care what you're paying your property management company. Most of the time, you just care how well your building is managed. That's really the most important thing, and how little you're spending on maintenance fees. That's really the bigger item. So that's one line item, we call that. In the case of a rental, under the same bucket, in the case of rental, we make a percentage of the rent. So if you're a big REIT and you've chosen Tribe to manage a big 1, 2, 3 portfolio unit or a building a portfolio with 200 units, we make a percentage of the rent that we collect on behalf of the community. So that's kind of really sticky business, and that's one big bucket. We call that software and service, because you get all of our software included in addition to services as well. The second bucket is what we call operational transactions within the or transactional operations within the building. So think of that as in-app purchases. Think of it as you're a homeowner, you want to interface with the building, you want to vote, you want to get financial history, you want to get documentation because you're thinking of selling your condo, you want to book an amenity, all the stuff that you're interfacing with the building and everything around that. We generate revenue, we have opportunities to generate revenue from, and that it's a long list of items, inclusive of you hire us to do rental for you, and we do lease ups and stuff like that for that particular unit or for that particular building. And then the third bucket of revenue, which is our youngest and yet the most exciting, arguably, it's our marketplace. So we spent, since we've spoken to you and your viewers, we spent a significant amount of time to build a curated marketplace, digital marketplace for our homeowners, for our tenants, and for our condo corporations to be able to directly interface and transact with service providers. And think about it this way: we're in a building, we know who lives in the building, we know how big the units are, we know if they're married, we know if they have kids, we have all that data, so we can actually curate products and services very specific to you, and you can actually directly interface with it. And because we have 100,000+ people living in our communities and in those 45 or 48,000 homes, we can actually really go negotiate on behalf of our homeowners deals that they will never be able to do themselves. Even some of the REITs don't even hit those numbers that we're managing. So that is, we make a percentage of the transaction, we disclose it. So if you're buying insurance for your condo, for example, and you bought it for $50 a month, we make a commission, we disclose it to you, but you have the convenience now of 3 underwriters giving you quotes and you choosing the right one for you. So that third bucket of revenue is called a digital services marketplace, and that's kind of at a high level what those 3 buckets of revenue look like.
Mm-hmm. Great. Let's talk about sort of the last year. Like I said, very busy last year. Is there anything that stands out? Is there anything you're more proud of or more concerned with? What are the highlights and lowlights of the last year?
Yeah, the big highlights really coming out of COVID was, will new construction catch up to the delays that it was experiencing over COVID? So we work with a lot of developers that are building brand new communities, in addition to existing communities deciding to come to us. And we saw over COVID massive, the traditional things everybody's been listening to on TV or radio or in the news, things like supply chain issues. We had, believe it or not, buildings that were completely ready for move-in, like condos, and they couldn't complete simply because they were missing a $6,000 fire panel that will run the building, and you can't get occupancy permits unless you have that safety inspection completed. In some cases, in some cities across the country, hard to believe, but developers were waiting 120 days for the city to be able to roll out an individual to actually do an inspection of the building, simply because they didn't have the resources. I can go on, like literally tens of these types of examples, or can't get the right appliances into the units, even though the building is completed and people can't move in. So going through COVID, the question we had in mind was, especially late last year, will the market be able to catch up in terms of finding resources? And if that's the case, are we going to be able to gain some of that recurring revenue that we were anticipating that had to get punted on, essentially? And thankfully, the quick answer has been really, really positive. If anything, we got jammed. We got a lot more buildings to light up with people moving in them than we anticipated. The other big highlight, obviously, and depends on which side of the fence you sit on, but obviously rent has been still continuously going up. There's really very small number of units available in the big markets we operate in. This obviously has created an upstream push towards rent, and we make a percentage of that rent. So while we're incentivized to make people live an amazing experience in the building that they're in, we just naturally tend to make more money as more buildings are 100% running with zero vacancies. So that's been also a trend that we continue to see. And now that we're a national player, one of the key things we're most excited about is the initiatives we have internally that allow us to leverage that national presence. So once you're a national player, like legitimately national player operating in 8 markets, you can do some really interesting things, like create your back office accounting system and do it for all 12 companies you've acquired through one place and one version of the software, integrated into one version of our portals that we use externally. So sounds like not as sexy of an outcome, but to put it in perspective, there is no property management company, even the few billion, like the ones that are worth a few $1 billion. There's only 2 that are actually national outside of us, that actually have centralized all their operations. All the operations are decentralized. We're the only ones now that are fully centralized. So if you live in one of our buildings and a condo corp in Toronto versus Vancouver, you're receiving the exact same financials, using the exact same tools, and getting the same level of audit ability and work that we've been able to achieve. So again, that's been a big opportunity for us that we're very excited about, and this will impact our profitability significantly, as we have a lot of areas there for efficiencies.
You touched on something I was going to get at. I might as well tackle it now, but you're seeing it firsthand. We've talked for a bit, outside of this discussion about a housing crisis, rental crisis. You're in the front lines. Like, what is it really like out there? Are we seeing? How is this going to manifest itself? Like, what happens from here? I mean, we keep hearing headlines about how many immigrants are coming in, the population growth, and what are you seeing on the street right now?
Well, listen, I mean, the math doesn't lie. 1 million people coming into this country do not have places to live that can satisfy that influx. That's just the truth. The federal government, provincial government, and even cities are working really, really hard to try to come up with clever solutions. They're slightly addicted to the big fees that that they're layering on all the developers. So we being people from the industry having a clear view, front view on the activities that are occurring with things like this GST waiving that the Ottawa just announced, whereby developers that are building rental communities will be able to not pay GST. That's a welcome addition. They need to do a lot more, but really that's a welcome addition. Being able to approve projects a lot quicker, and that's probably the number one complaint. I think if you put some truth serum in most developers and you said to them, listen, even if it costs you a little bit more, but we can get you approvals on your projects, and shorten that period from 3 to 4 years to down to a year, would you pay more? And believe me, I think 90% of them will say yes, I would. That's the number one problem. So we need to get out of our own way, if that makes any sense. But to get a little bit more on the micro level, look, the interest rates hikes have definitely affected the desirability with inflation, have definitely affected the desirability of new condo starts to kind of press the button, right? You want to be able to have a high level of certainty that you can pre-sell a significant amount, and that your price cost certainty is going to be within reason, so you can make some money on it. And I think right now, most developers will tell you we don't feel incredibly comfortable, especially if they just bought the land in the last couple of years where the land cost is high. If they bought the land in the 70s and the 80s, different conversation, because their cost base is very different. And that's why you will still see more activity. But that is probably the number one thing. There's no doubt there's less exchanges of units that are occurring in the markets we're seeing. But that tends to be at the higher end, 1 million, 1.1, 1.2 and higher. Condos, 600 grand, 700 grand, 500 grand, there'll still be a big market for it. On the rental side, we're seeing a little bit more rent control conversations being introduced, but thankfully, which that can be an issue for a lot of the developers that are building, but thankfully the cities are starting to create some clever ways to work with a developer and say to them, look, we understand, Mr. Developer, you just amassed this piece of land. You're asking us to put 4,000 condos on it. Can we do a deal? Can we give you the 4,000 condos, give you a little bit of height, and what you're gonna do in return for us is deliver us 1,000 units under what they call the below market rental. Just guarantee us you're gonna make them available for rent for 5 years or 10 years, and then after that you can convert them into condos. So because we get involved, we being Tribe get involved with master plan communities, we actually are front seat watching this, which is one of the main reasons why we like being a rental management solution, having rental management solutions as well as condos, because for those developers, they frankly don't have any rental muscle. They know how to build a building. They don't know anything about how to manage a rental community. But I think a lot of the cities are starting to clue in that if we do this, we will allow these communities to have mixed use purpose living. And if that's the case, that will solve some of the problems. So it's a long-winded answer to tell you there are a long number of ideas that are being contemplated in different markets, but the truth of the matter is the math just doesn't add up yet. We still need a lot more housing.
Yeah, no, agreed. And what's the percentage breakdown versus rental versus owned units that you manage?
So 2/3, 1/3, 2/3 condos, 1/3 1/3 in rentals. The revenue per door per rental is higher, tends to be higher than so on the revenue side, the percent will be even will get a little bit closer, but that's a good rule of thumb.
Gotcha. Perfect. The M&A pipeline, are you guys, maybe describe what you're kind of looking for, if anything, and how robust is the pipeline right now?
Very robust. We look for the majority of the acquisitions we've made are traditional property management companies, well managed, an element of acqui-hire. So we really do like a group of entrepreneurs that are running the business that want to grow with us in that market. We tend to most of the time be already in the market, so our market intelligence is there. We tend to be purchasing companies that we've either competed with or we will be competing with. Now, when you're national, like company like us that's national, there's literally no property management company in Canada that would not know about Tribe. So it's an easier conversation. We call and say, look, we like the market, we're coming into it, or we already exist in it. We think 1 + 1 = 3. What's your strategy? This is the kind of leads we're getting, leads and deal flow we're getting in the market. You probably don't have that engine, Mr. Entrepreneur, despite the fact that you're working really hard. You don't have an engine for marketing. You don't have an engine for, you certainly don't have a software engineering team. You don't have an engine for IT. You don't have an engine for all the stuff that we can bring in. Why don't you join us? Here's the economics of the deal. And we tend to buy really, really well and give them an upside as we go. One of the best stats we have is that we have much higher retention rates once we buy a company than prior to us buying the company. So that kind of tells you that what we're doing is sitting right with the customers.
Yeah, for sure. Before I continue, I should remind everybody, if you've got a question you'd like me to ask Joseph, please use the chat function and I'll ask that question. Obviously the industry is going through all sorts of turmoil, whether it's because of interest rates, very, very low vacancy rates, all these things we kind of touched on. What does it look like going forward? And part of the question too is like, what challenges are you facing because of this in the business?
Yeah, great question. I mean, we've got perception challenges. I'll start with those. A lot of people think of real estate transactions as slowing down. That doesn't bode well for a company like us. The truth of the matter is, we've got way more business available to us than we can actually handle. So we're actually very selective in the business we want. More and more of Canadians and arguably people in North America are moving into multi-MDUs, what we call multi-dwelling units. And those are either rental units or condos. So a lot of people that think, oh, real estate is not a great sector, in our case, we just continue to grow. We've been a Fast 50 company, and we think we're going to be another 2 years in a row Fast 50, which is unheard of for a micro cap, as you probably know. So we continue to grow year over year, and our organic numbers are great. Our M&A numbers are great. So one of so that would be one challenge. Another real operational challenge for us is more and more markets are becoming licensed, or you acquire a license to operate in them. So the good news for us is, having cut our teeth in British Columbia, this is where we came out of. British Columbia has always been licensed. So we actually have built tools and technologies and even training manuals that are very specific to ensuring a high level of licensing operation for our staff. Fast forward, we go to Toronto or Ontario, and Ontario is bringing in these new rules in the last couple of years, and there's less and less people available to be hired. So the good news is we have a method to go and identify the young talent and attract them to us. Arguably, people that would have never even thought of property management as a career are coming to us and starting with us. The bad news is we're growing so fast that we can't really catch up and do it fast enough, if that makes any sense. So that's one of the interesting, I call it first world problem, but it is a problem that we have to address. And on the positives, though, all those buildings have to be managed. They have to grow. And what's interesting is that once you become a national player, in our case, new revenue streams really start opening up because of the massive growth you've got and the size. And all of a sudden, you really can hone down on your path to profitability.
The fact you're growing so quickly, you're still acquiring. What's your financial position look like? Do you have to raise more money to continue to do what you're doing right now?
That's a great question. We're in good financial position. It's tough to tell our profitability, how close we are to profitability from our last Q2 numbers. I have publicly spoken about the fact that we've taken a lot of measures in Q2, Q3 that we won't see the benefits of in terms of profitability path till Q4, arguably financials, and Q1. We do have a plan to accelerate our profitability path, and not at the expense of growth. It just really generally more of once that you're a national player, as I was speaking earlier, that your back office expenses start going down due to the size. We really don't need to go back to the market for capital, simply because we are fortunate. Again, publicly, I have spoken about the fact that A lot of the big banks that, well, there's only 5 of them here, but the 5 banks are admirers of our ability to buy companies, how we buy them, how much we pay for them, and how we operate them essentially once we acquire them, to a point where we've got actually more than $12 million of M&A working capital that's available to us.
Maybe, I mean, what's typical terms when you do make an acquisition? What does it usually look like?
Well, traditionally, we would give some stock, cash, and we do what we call vendor buyback, which is basically terms that are over 3 to 5 years, that are very specific to the performance of the business. And I'm very, very proud to say that all the vendor buybacks that we've ever done historically have all been almost to the penny, in some cases more, because the business have outperformed what we expected. So we really hold their hand and make sure that the business is operating strongly. It's not going to be a surprise to you, but maybe for those that don't know, we're trading below 1 times revenue and run rate right now. So we, just like all the other companies, got kicked hard in the market, despite the fact that we're not the exact same as every other company. And don't get me wrong, nobody's baby is ugly. Everybody's kid is beautiful. But I look at our company financially and fundamentally, and I go, okay, like, growth year over year, we're run rate to do $20 to $21 million in revenue this year, and we're trading at $20 million market cap. Like, that's crazy. Anyways, point is, and I don't want anybody to feel sorry for me. Don't worry, I don't feel sorry for myself. But the point, really, the takeaway is, I don't want to be given stock at these prices. This is incredibly cheap paper right now. So what I'm doing very cautiously is, I actually, believe it or not, went out and renegotiated a lot of the MOUs that we've got out to actually expand the vendor buyback. And only when I really like the entrepreneur, I will give some piece of stock, because I do want them to be with us for 3, 4, 5 years on the journey.
Yeah, makes sense. I had a question that came in. It's more to, like, what's the end game here? What do you see? Where do you see the business in 5 years? And is there an exit strategy, or is this, are you the exit strategy for a bunch of other players?
Yeah, no, that's a very good question. This is where I usually, go stoic face and go, no, we're building $1 billion company. Just leave us alone. Truth of the matter is, there's nobody doing what we're doing. It's not gone missing on private equity. This is the largest addressable market that nobody ever wakes up thinking about, okay, except for us. Like, nobody knows, I'm telling you this straight up, that it's $110 billion of addressable market annually. This is just in condos, okay? This is what property management looks like. It's the biggest thing that nobody thinks about. Now, private equity isn't stupid. They're very, very clear on it. Private equity isn't new to roll-up strategies. The most unique thing about us is we're the only ones attacking condos. We're the only ones. We're the only ones with that platform. Add the fact that not only are the only ones with attacking condos, there's a couple that are attacking rental, but we're the one that actually have both of those the technologies stacks on top of each other, working together harmoniously. So add the fact that everything we do here is replicatable in the US. I think the exit strategy, and I'm not just speaking out of school because they're always in touch with us, is going to be private equity.
Yeah, fair enough. All right. So we're investors. We're paying attention to your business right now. What do you think are the most important, call them milestones or catalysts, or any kind of metrics that we have to pay attention to really understand that you're sort of continuing to go in the right direction?
Yeah, that's a fair question. I think the number one thing is we've had growth per door. I don't like the word door because it dehumanizes people that are living in it. But we've got increased revenue per home, and we've also increased our revenue per customer and the number of homes that we manage literally since we've gone public, quarter over quarter. So that's consistent growth. The fact that we're knocking on $34 per month per home, in addition to $6 transaction fees. This is our Q2 numbers.
Mhm.
That's incredibly impressive. We're starting to knock on $40 revenue generation. So what should you be looking for? Look for us to continue to grow that. Look for us to continue to improve our gross margin. We've gone from the 36, 37% now to 41% as of last quarter. And I do think I see a path to 50. Look for us to make more acquisitions, very strategic acquisitions. Every acquisition we make are accretive. They're all cash generating, that will improve their profitability once we get in and put our systems in it. And also look for us now to start growing the revenue coming in from the marketplace. And you'll see a few announcements in the next while here, specific to partnerships that really unlock the value of a building. I'll just give you a very basic example that I think, again, everybody wakes up in the morning, doesn't think about. Electric vehicles. So here we are, I'm currently in Toronto. If you go back to Vancouver, anywhere you look, there's Teslas, there's the Ioniq 5s, there's the Ford, everybody's doubling down on it. Well, guess what? All those people, and just the number, just so you're aware, in Canada was 14%. 14% of vehicles sold in 14% of vehicles sold in Canada last year, brand new vehicles, were either plug-in hybrids or electric vehicles. So they need to get charged. In BC, that number was 22%. That number would have been 28% if the inventory was there. 28% of cars that would have been sold last year would have been either plug-in hybrids or full-out electric. So you layer that on top of, well, where the heck are people charging these things? So obviously you've got your traditional model of superchargers and this and that. But where are you going to do that if you live in a building? And most buildings, if overwhelming majority of buildings, are not equipped for that. Can you just rough out an outlet and just plug into the wall and pull electricity from the building? No. And what happens if there's 15 of us in a building that have Teslas? We come home at 5:30, plug in, go upstairs, do the laundry, cook. It hits a spike, and that spike, I don't want to get too deep, but believe it or not, that spike that your building hits becomes the rate that you pay for 30 days at the highest rate. So a quick, simple math, real numbers, by the way, a building of 100 units that has 10 cars that spike up at 5:30, and that budget a month could actually increase by $10,000 if you're not careful of how to moderate your electricity. So now that I've shared with you the problem, what is the solution? Well, the solution will be, what's called EMS, or energy management system. Well, how do you bring it in? How do you get everybody to get consensus on it? Where does it plug? How do I get my data? Are we all going to download different apps? No, the answer is you got to integrate it in one solution, bring it in. And we think we're incredibly equipped to solve that particular problem. So we're actually investing heavily on that. But here's the more interesting part of that. If you do it properly, we get carbon offsets. So your actual building now starts earning carbon offsets. So by us being plugged into a carbon offset marketplace, we can actually not only lower your operating costs, but actually bring in dollars coming your way as a building, and we can share that with you. So I use that not to kind of be dreamy about what's going to be there in 10 years. These are actually problems that we're solving as we speak. And a lot of people don't know this, but we have an AI platform that allows us to benchmark the performance of all of our buildings. And the reason that's relevant is because that AI platform can also go out and actually read the minutes of every meeting that's occurring and identify ones that are speaking about EVs. And then we can put an offer in front of them saying, well, we know you're talking about it. Here's solutions for you that you can actually lower your overhead with. So, these are things we're going to start being a lot more active on now that we have this massive footprint. And by the way, a lot of these conversations we're already having with developers building new communities for the next year or two.
That's fascinating. I've learned a lot about EVs in this interview about property management. That's fantastic. Listen, as we wrap up here, what have we not covered, or what do you want to make sure everybody walks away with? What's a key message today for everybody?
Yeah, the key message is we built an amazing company. It is one of the fastest growing, not only in our industry, but it's literally one of the fast 50s in the country. We certainly haven't maybe done all we can to tell our story externally, and I think that's probably one of the reasons why we don't have great liquidity in our stock. That's changing. We're very, very active and now going out and letting the world know about what we have. We've kind of, I don't want to use the word ignored, but maybe neglected retail. We've been fortunate enough to have massive funds that really like us in the space, that have done a lot of due diligence on us, to come in, and they're just not active selling the stock. So that's why you end up with an illiquid stock. We're changing things. We do recognize the importance of retail. We think we're one of the best stories that nobody knows about in the market. We don't have debt on the books, even though we're taking on that big facility. It's an M&A debt facility that we're going to be leveraging to buy more businesses. We see direct path to profitability, which I think is the most important thing. And we have 3 analysts, actually 4 now, that are covering us, that think we should be between the $3 to $4 buy, and we're trading at $1. So we think we're tremendous value. And for the record, I'm buying. So, and you can go see that. So, and nobody of my big shareholders is selling.
Always a good sign to see insiders buying. I like that. That's a perfect place to sort of end this conversation. But Joseph, thank you for this update. I really appreciate it. We've been speaking with Joseph Nakhla, CEO of Tribe Property Technologies. The symbol again is TRB on the Venture Exchange. Joseph, appreciate catching up today, and certainly look forward to catching up in the near future.
Thanks so much, Paul.
Thank you.